Welcome to the Dividend Talk podcast, episode 53. Pay down your mortgage or invest the money. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you are new to this channel, please hit the like button and subscribe to us. And check out our previous episodes on YouTube and Spotify. See you on the inside. Hey, good evening, European DJI. How are you doing today?
I'm doing pretty well, I must say. As you know, we usually record on Friday. Now it's a little bit later on Sunday because I got my second vaccine shot and made me quite tired. So thank you for being so flexible last Friday. It helped me out a lot because I slept a lot. How are you doing?
I'm glad you're feeling better. I kind of wish we did it on Friday now because you can probably hear I'm a little bit bunged up myself. But I haven't got the vaccine yet, so hopefully it's not COVID or anything related to that. But we'll see. My son had it during the week, and it was gone within a day, so I'm pretty sure I'll be fine tomorrow. But hey, the show must go on, isn't that what they say?
Well, this is where you, how you say it, separate the real men from the boys because you're showing up and I had the men's flu on Friday. So I guess that's the difference here.
Yeah, us Northern Europeans we're tough up here. The cold weather helps us,
Yeah, you've seen some sun last week and straight away sick afterwards, right?
Yeah, exactly. Yeah. Maybe I have sunstroke or something from it.
Well, talking about sunstrokes, I mean, what I get a sunstroke from were all this whispering around inflation and the Fed last week. I mean, literally everyone is talking about it. Not even anymore on FinTwit, but just literally in the streets, people are talking about inflation.
Yeah.
And it's really insane how it's keeping the normal average Joe busy at the moment, right? Yeah, so this is really the news from you also from the week, like how it's hitting Main Street inflation. I mean, the Fed is saying it will come in 2023 from the European Central Bank. Well, I don't even follow them anymore. I mean, what they are doing, it's just insane. However, when I see the Greek debt pile that they have, the last thing they want is increase interest rates because it will be the nail in the coffin of some countries with really high debt loads. So it just shows how difficult it at the moment is in Europe with the story. But we also saw it in the listening questions today, right, around inflation. Yeah. So it's literally inflation everywhere.
Yeah, lots of people are worried. Some people are not so worried. And as you said, we have some questions. So we'll definitely be touching on this topic, I would imagine, a lot more over the next couple of episodes.
Yeah, and what I actually found interesting, right? I did a small video about inflation, like when was it, 2 months ago or 3 months ago already? Because for us who read 10 Qs, right, the quarterly reports and such, it was so obvious that it would be coming, right? And we saw the things in the working capital with the inventories and everything. We could really see that the inflation is already hitting the cost numbers in the company's quarterly results. So I'm really interesting to see how it will look like in 2-3 weeks from now, because then the new quarterly results will start coming out in mid-July. And I think, let's say it like that, I wouldn't be surprised if the numbers will be a little bit less, I say it, joyful like they were after Q1, because after Q1 they were really hot, like numbers of Apple and such. I think we'll see now more the inflation card being played all across the board.
Hey, and we might actually get to see this dip that I've been praying for since, I don't know, early October. We might start to see some volatility at least.
Or since 2014. I've seen probably one real dip, and that was like March 2020. That was my 3 weeks in that I had of window of opportunity in the last 6-7 years. So it's just this old thing, right? time in the market beats
Yeah,
timing in the market. Yeah.
yeah. I had the same conversation yesterday evening with a friend as well, who's probably a lot smarter than me when it comes to business and investing. He works in this environment, which obviously I don't. So he's quite intelligent in that space, but he has yet to invest any money because he's constantly waiting. Whereas I'm like, I'm in here now 4 years, and while you've been waiting, I've been
Yeah.
earning money. Like, so it's so interesting. Like, to when you have people that are in that space still waiting for this crash and
Yeah.
hemorrhaging money.
Yeah, I think too much knowledge can also be a curse. Yeah, and I think what you're talking about is just being streetwise. I
Yeah,
think because you've been collecting the dividends, reinvesting them, got benefit of the compounding, and if it dips, well, we know our companies from studying them, so we'll just
put
pull up
more
the
money
wallet,
into it.
right? Yeah,
Yeah, open up the wallet. But anyway, I had a little bit of news which I thought might interest you, because I know you're a recent shareholder of Alibaba, and I just find it so intriguing, this whole dance they're doing with the Chinese government. I know back in, was it October, November, um, Jack Ma made some comments. He had to go into hiding almost for a little while, and now they've been fined 2.3 billion from the Chinese regulators for anti-competitive tactics. I mean, China of all people suing for this is really incredible. But it just seems China have a sting in their tail now for Alibaba, and it's something that if I was to be a shareholder, I would be quite nervous of, because we all know the Chinese government rule the roost, and there's not much room for a company to maneuver over there.
yeah. It's interesting that you say that because it was pretty well known that this would be coming up, right? So I discounted for that already, and I hear there's a lot the fear of the Chinese government over the stock market. But look at what the American government is doing to Bayer or the court system and how they are regulated, but also the FTC and such, what they are doing to Facebook, what they are doing to Johnson Johnson. For me, I think in Europe it's probably even the easiest because you know what you get. But in America and China, it's a bit unpredictable. So I think this is also a reason why Chinese stocks like Alibaba are also trading more at a discount compared to the American peers. Um, but to be honest, I trust the American institutions just as little as the Chinese institutions. Just if I see how often American let's look at what's happening in Europe always, right? The Volkswagen deal, scandal. America find them straight away. In Europe, what's happening here? We're still talking with each other.
Mm-hmm.
Yeah, it's always the same in Europe. We talk about it, but nothing happens. And in America, straight away, up, fine, few billion. You shall not do that again. So for me, I understand that for us in Europe, we understand the Chinese culture less, hence we will probably, because of the unknown, have more fear for it. But if I just look at the cold facts, I don't see that Alibaba is that much treated differently like Facebook or some of the other too big to fail kind of tech companies.
Yeah, sometimes though it's better the devil you know, and I'm fully aware of what the American and European governments can do. But as you said, the Chinese culture is different. They have a history of, I mean, they have completely different culture. They don't like companies getting too big or anyone getting too big for the boots. I mean, I could not imagine Mark Zuckerberg going underground hiding from the US government.
No,
Maybe he
no,
could, but
no.
like these kind of things are real concerns, and we just don't know with the Chinese government. Is
Yeah, the
my big
tactics
fear.
are probably a little bit different. But if you think about Facebook, I can see Facebook being broken up. Yeah, I could see that that happens to Alibaba. So I'm true. You're right with the Zuckerberg probably doesn't need to go underground, at least not for the government, but rather for just general haters. So yeah, but Baba, it's like, what is it, 1% of my portfolio, maybe
Yeah,
1.5%. So it's a little bit of this money that I use for non-dividend stocks, but I see them as more like value plays. So I bought now some more at 210. probably I would sell them at 300 or something like that. Or I will let them ride if the fundamentals keep growing. I will keep them. I don't know.
Cool. Okay, we might jump into our main topic, which is going to be quite interesting. We come from different countries, so I'm pretty sure our rules or rates and all this will be a little bit different. But a question that is asked a lot of the time is, should you invest your spare money or should you pay down your mortgage? Which camp do you sit in?
For me, it's a little bit of a mix. I pay down my mortgage actually on a monthly basis, right? Because I pay down my principal over 25 years. But maybe let's start a little bit to talk about the system here. So when I was living in the Netherlands, right, you would lock in your interest rate for, let's say, another 10 years or so, and you would pay, let's say, at the time I paid 4.5%, I think, back in 2007. Then I had it for 7 years. Then I refinanced it after 7 years for, I don't know, for 2.5%. And I think now you can refinance for less than 2%, which is really attractive, right? Then you have a really low yields. And then the question automatically comes, okay, but if I can get a dividend stock for 3%, why would I pay down my mortgage, right? But here in Poland, it's a little bit different. So it's really, really hard to lock in your interest rate. I think there are only one or two banks that allow you to do this for 5 years. So what the majority of people have here, they have kind of the 3 months interest rate. It's called FIBOR. I guess it's connected to the central bank of Poland. I'm not sure. But then you negotiate your markup with the bank. So my markup is 1.9%. And here they take into consideration your risk profile, all these kinds of things. So I'm a foreigner, so my risk is, of course, really high. But I think usually people can probably get something between 1.5 to 2.5 or something like that in a wide range. So I've got 1.9 plus the 3 months running rate, which is, I don't know what, slightly above zero at the moment, or maybe 0.2, 0.4. But there was a time my total mortgage rate was about 3% for quite some time. So that's the situation here. But always it has been since I live here below 4% mortgage rate.
Okay. Poland seems quite similar to Ireland in the sense that typically you don't have long fixed term interest rates. You have, as you mentioned, 3 5 year is probably maximum that a bank may give you, but certainly not 10 years or above. I know we were speaking to some of the guys in the Dividend Day chat that they can get a 35-year fixed rate, and that's just not possible here in Ireland. It was interesting you said draw 1.9% markup. I was just looking at Statistica right there. And Poland and Ireland are quite similar at the moment with the average rates. It's around 2.7 to 3%. So you look like you're getting a pretty decent deal out of that compared to the market at the moment. My situation is a little bit different. I bought my house back in 2008. Just missed out on the tracker. At the tracker, it was like the same rate as the central banks. Just missed out on that. So I went on a 4.25 variable rate, which I'm still on at the moment. Some of that is due to my own fault, and then some of it later on I had some financial troubles. I went back to college, and we had to renegotiate a deal and so on. So I'm still on that rate. I'm trying to come down off that. I am paying off my mortgage to reduce that, but it's overall I think Poland and Ireland are quite similar in the setup of the mortgages compared to, say, the Netherlands or Spain,
Yeah.
for example.
I know that my my sister, she locked in an interest rate for, I think, for 30 years for 4.8%. I don't know when, 10 years ago or something like that. And it was really simple for her. She thought like, oh, this 4.8% is so much cash flow from my monthly salary. I know I can pay this for the next 30 years. It gives me comfort. She was afraid it might go higher, so that's why she wanted to lock in this, and knowing that it might be much cheaper to take a shorter period. But she said, "Look, EJ, I'm not familiar at all with all this stuff. I don't understand finance, so I just lock it in. I know I can pay it. I know my salary might grow a little bit over the next decade, so then it only becomes cheaper for us.
Yeah. Yeah. The psycho. I think this topic is more psychology sometimes than numbers, because
Yeah.
from my perspective, from an Irish perspective, if I'm to write down the numbers right now, it's a no-brainer for me to pay down my mortgage and nothing else, because I'm on a 4.5, a 4.25% rate. If you were to take a high earner or even a low earner, you have to earn 21% more to match what you're paying there.
Mhm.
So it's an absolute no-brainer for me to do that, but I don't do that because when I started my mortgage 10 years ago, we had a great job at the time. I was overpaying. We overpaid really, really a lot of money at the time for us. And then when we needed that money, we couldn't use that to offset. We couldn't say to them, look, we've overpaid by 20,000. Can we have a break for 2 months or 3 months? And they would not let us do that. And it really kind of affected me. So I like to have control over my money. And that's probably the main driver for that reason. Because if I ever run into difficulties or anything like that, I'd like to have some element of control. Now I still overpay on my mortgage, but it's a small fraction of amount than what I used to pay before that.
Yeah, if you would think that banks would become more consumer centric, right? And they
Yeah.
would see your payment history and thinking like, hey, this guy's paying like much more. Okay, if he wants to have a holiday break, they're in a bit of financial trouble. Yeah, they
Uh,
might need it a little bit for 2, 3 months, and we'll have a happy customer.
so during that time, there was a there was a house close to mine, which is actually closer to my in-laws, right? Closer to
Hmm.
my father-in-law. And we worked out the numbers. If we were to buy that house, if we were to transfer that house, it would have reduced our payments by about €500 a month. Okay. We rang the bank. I was just going into college at the time. So my income was coming down, even though we hadn't started a business at that time, but I was still working part-time, but it was more than enough to cover the payments. So rang the bank, went through all the payment schedules, went through everything. We'd be paying less money than what we're paying now. They turned us down, right? And what was the reason they turned us down for? They said on paper we could not afford it. Okay. And I was there. So I'm paying €500 extra right now, and I'm overpaying on that. And you can't let me move to another house where I'm paying less money because I can't afford it. And the man in the bank said, this doesn't make sense, I know, but we have certain rules to abide by. And on paper, you can't afford that. So they turned us down. I was shocked. Absolutely shocked.
Yeah.
Yeah.
So, yeah, well, you know my opinion about bankers. So,
Yeah. Look, it wasn't his fault. And this was probably a result of the financial crash in 2008, where things had to become a little strict. But I just, I just found it so bizarre that they could do this. So that's kind of always shaped my thinking into
thinking. Yeah.
not overpaying, not putting all my eggs into that basket, even though it would make the most financial sense mathematically.
Hmm.
I prefer to have control over my my finances, and particularly from an Irish standpoint, it's different from a European standpoint because the rates are lower. I mean, if you're paying 1%, 2%, it's more of a no-brainer to invest in the market because you can. I mean, you could throw a dart at a stock and probably get 3% a year.
Yeah. Yeah. So it's interesting that you say it because from that point of view, I've got a relatively low mortgage rate, but I still prefer to have it at a certain threshold. I don't want to have 100% debt on my house. So maybe
Mm,
that's also a little bit like how I look at this. So I look at it at my finances. I look as like I'm a business, like EDGI Incorporated. So I wrote
yes.
my annual report,
Yeah.
as you remember as
Yeah.
well. I didn't put there my net worth and such because I keep that out of my blog and out of Dividend Talk. But how I look at it, if I would invest in myself, I would look at my assets and the debt to assets, yeah, as an example, but also debt to equity. So I don't want it to be I say I don't want the debt to be higher than 60% compared to equity, as an example. So this is how I really look at it, because it means that if at a certain moment something happens and I would need to liquidate everything, that I have enough money left to pay off all the debt, and then still money left to make decisions, life decisions, right? So I wouldn't feel comfortable having 100% debt on my mortgage. So for me, therefore, it needs to be lower than 60%. Well, I've got it now lower than 30%. So I'm on that, and it's fine here. So what it means for me now, I also look at the interest coverage rate, and I pay two things in my mortgage. I pay back principal every month, and I pay back interest. So
Yeah.
if I take the principal out, because that is just debt repayment for me, and only look purely at the interest component, I think I have an interest coverage of 15 or 16 at the moment. So for me, this means I've got a really healthy balance sheet from that point of view. My asset is really well covered with equity, not only with debt. So now for me, I'm just keeping this debt to play the interest game, where indeed, like you said, if you throw a dart, you will get more than what the interest rate is. But this is how I look at it. So for me, it's really like I try to manage my own finances, like if I would invest as a dividend investor in myself, right? That's really how I try to take that perspective.
Yeah. It's a really great way to look at yourself as a company in that regard. Debt to equity, what you typically look for, 50-60%. So you'd like to have
Yeah,
your
sixty
mortgage
percent. Yeah,
50, so you get down to about 50%.
yeah.
Did you invest? Did you put the money into the mortgage until you hit that point?
Um, I put most money in the house and
Yeah.
then finance the rest with a mortgage.
Okay.
So I had some money on the side, which I paid a lot for. Then I started paying down a bit, and at the same time I started investing. So I used two parallel streams. I was like you, I believe. I was investing, but also paying down. And at a certain moment, I just stopped paying down.
Yeah.
Yeah, and that's how I effectively did it. So I got more cash flow also for my investments, which also helped my savings rate as such. But still, I would prefer to have no mortgage at all once I hit the fire date, the expense coverage. Although I'm not entirely sure there. So how I look at it now is like I have an investment goal every year, and I want to achieve that. And then when there is some money left, I want to put it in my mortgage.
Mhm.
But I'm the same like you. I want to have flexibility, and having 100% of my cash stored in my house, let's say, is not something gives me flexibility or I feel comfortable with, because then I would need to ring up the bank again, and you know that when you ring up the bank, you always get the worst deal when you're in need for money. So I rather have I rather let the mortgage with the monthly pay down pay off the house by itself over the next 20 years than
Yeah.
I do additional payments.
Yeah. And I have to say, actually, it's my wife who's the main driver behind paying down the mortgage. She doesn't understand the investing world or anything, that has no desire, but she does. She can see what we owe on a mortgage, and for her, it's more of a peace of mind that we pay down on that. Even if we could beat what we were earning, that has no bearings on her decision. It's more, I see $250,000 or X amount, not saying it's $250,000, but I see this amount of debt and she wants to pay it down. So it's purely psychological for her. And it's the main driver why we pay so much off it at the moment. If it was purely my decision, I may not be paying off exactly what we're doing now, but
Yeah.
we're a team, so we have to split where our money goes.
Well, it's interesting that you're saying it, because actually I started investing because I got inspired by a book from a Dutch author. His name is, I think, Gerard Horman. And he wrote the book, Finally Without a Mortgage, or something like that. I think that was the title. And I read it over the summer. And he taught me the first lesson of compounding, or something like that. So imagine that you are paying 400 euros a month on mortgage, yeah, and that includes your interest, but you can you could pay 500 euros. So you put an additional 100 euro every month. It shows kind of an inverted snowball, because if you start doing that, your principal becomes lower every month. And because of that, you start paying less interest. Because of that, you can, instead of 100 euro, you can next month, I don't know, pay 100 euro, 100 euro and one, and then 100 euro and two. So that's what I got inspired by, and I started doing that with my mortgage. And once I started doing that, I actually shifted a part of my savings that were just collecting nothing on interest, because I didn't know what to do. But I was learning from my, effectively, I guess, my parents always saying like, oh, you need to save. So I was just saving, but no interest rate. So that's when I, for the first time, started to think about my making smarter money decisions, and why I started paying down the mortgage. And then I saw the snowball. I did it for a year. And then I started to read some more finance books. I got a bit interested in it. And that's how I discovered then dividend investing. But the first time ever that I started to make money decisions on a conscious way, that I felt like how you say it, enlightened almost, was after reading that book. I felt like, wow, because this author did a really great job in showing what you could do. Because he said, if you have got your mortgage down, you and this is like, let's say, one third of your expenses, well, you can work 1.5 to 2 days less per week. How does that sound like? And that really, really inspired me to start working
Yeah.
4 or 3 days just by paying down your mortgage.
Yeah.
So
That was
yeah,
your light bulb moment.
my
Was
light bulb moment.
Yeah.
Yeah.
I'm really happy that you mentioned compound, because we speak about compound interest or compounding working for us in dividend investing, but in your mortgage it works against you. It has the opposite effect, because that obviously interest is there working against you. So paying off extra, like you said, and one trick that we learned in Ireland, if you pay weekly as opposed to monthly, you make, I think you make 4 extra payments, which is equivalent to an extra month every year, and that breaks it could knock like 5 or 6 years off your mortgage over the term of your mortgage
Wow.
in interest rates. Yeah,
Yeah, and I think I, what I what I would recommend everyone to do is just to check one time how much interest you're supposed to pay over the lifetime of your mortgage, and compare that to actually the price you bought your house for, or let's say the deal you made with your bank regarding the mortgage of your principal. And sometimes it's just more than the house itself.
yeah. I did that exercise, and it scared me how much I'm actually paying for this house. It kind of
Yeah,
scared me.
and that's what's so nice about it, right? If you then pay down 100 euros just in a month, you'll earn 150 euro back or something like that over the lifetime.
Yeah,
Yeah, which is
yeah,
a pretty good deal. And if you don't know how to invest, because we spoke about psychology, but if you don't know how to invest, in for instance, if you don't know how to analyze companies, and you don't feel comfortable with it, I would definitely always pay down the mortgage, but always keep some money aside for the flexibility when you need it.
yeah, yeah.
Yeah.
I would definitely always advise, especially people from Ireland, if you don't have the interest or you don't have the patience to follow companies. We spoke about ETFs, but obviously pensions are one way, but paying down your mortgage as fast as you can is probably the best way you can save your money, because compound interest is working against you. It's basically tax-free savings is what it is. And I've mentioned that before. If if I want to earn 4.25%, if I'm a high earner, I have to earn 8% a year. If I'm a low earner, 6% a year, just to match what I'm going to be paying off. So it makes absolutely sense. And I would never persuade someone not to pay off the mortgage instead of investing.
Yeah. Yeah, cool. So we're a little bit at the same journey there, but I believe you're still paying down additionally, right? If I
Yeah,
understand it
yeah,
right.
and
Yeah.
full disclaimer, I suppose people from Ireland might ask why I'm on such a high rate. I did mention that I went back to college. We contacted the bank, and during that time, we had to go into an agreement. It was called a PIP agreement at the time. I'm a lot more. I'm out of college 4 or 5 years. I'm a lot more financially secure, stable, decent income. I've been on to the bank every year to come off this agreement, and for whatever reason, they're making it very difficult. But I have what's called a split mortgage at the moment. It's working in my favor right now because I have X amount of money parked. My effective rate is about 2.1% because I'm not paying interest on the parked amount. And I only found out since last October that we could overpay. So until that, we were kind of put money aside in a savings account because we were under the impression, or we were told, that we couldn't overpay. But as soon as we got confirmation in writing that we could, we've paid down, I'd say, about 15% of our mortgage since last October. So it's working in my favor, but we're still trying to come off this agreement so we can. If I ever want to move house, for example, it will take 4 years for my credit rating to repair after this. So that's why I'm quite keen to come off it and to build up my credit rating again.
Well, if I hear you talking and I know a little bit in what situation you were and how you went back to college, I think you did a pretty amazing job. And I don't know how long your rate or contract is locked in, if it's forever or not, but I have a feeling like you've got your business pretty well arranged now. So
Yeah, do you know what? I kind of wish that I had this 10 years ago, or at least we were taught this in school. Actually, there was an Irish guy, Brendan, who contacted me by email by chance last week, asking a similar question about mortgages and investing. And he made a comment at the end of the email that they should definitely be teaching this in school. I 100% agree. It might save a lot of people a lot of heartache in the future.
yeah, I hear this so often, but I had this all at economics at school, but I was like 13 years old. We were calculating annuities and everything and principal payments, bond yields. I mean, when you're 13 years old, you're full of hormones. Who's making life decisions like this? You make this when you're 25, 26.
Yeah.
So why when we are 13, like, do they still think that we remember it 12 years later?
Maybe not. I mean, if you have some instinct, like when I was going looking at a mortgage, I did
Yeah.
not have one notion. And part of that is my problem because I should have educated myself before making such a big commitment. But I was so young. I was 18, 19 buying a house. I was so young. I just wanted my own house. That's all I wanted.
Hmm.
They were throwing contracts at me. They were throwing figures at me. I didn't even know about the tracker rate until much afterwards. I probably could have got the tracker rate if I pushed hard enough. I just did not know. At least if in school there was something mentioned about it, it might not have to be to the level of annuities or anything like that, but
Yeah.
some basic understanding. I may have had a better footing to educate myself. Maybe
Yeah.
not.
And I understand why you say it, but I also think you're too hard on yourself because if I remember 2005, 2007, 2008, before the crisis, I mean, I considered myself quite well educated, and they also lured me into some really shady agreements. And those banks in the Netherlands had to pay billions of fines for these kinds of mortgages policies.
Mm.
So I always have a feeling that we don't really have choice when we're at a bank. There is a lack of transparency and such. We can be educated as much as we want. Probably we would need to be a financial advisor or have a financial advisor in the family maybe that sells those things. But otherwise, you're really they just exploit your weaknesses. Yeah, they see a kid of 18, 19 years old, and I don't think I understand why. I think when you have never been educated in it, you might feel like I wish I was educated, but I was educated in it, and I feel like still it didn't change a thing.
Yeah,
Uh,
yeah, maybe maybe you're right. I still probably would have had the same feelings of I want my own house. I mean, 19
yeah,
years old, I just had this in Ireland. It's a culture. Like you're nearly asked when you're going to buy a house. It's such a big thing in Ireland compared to Europe, where the house ownership is a lot lower. So
yeah,
it's more
yeah,
of an expectation, and you feel, I don't know, more of a grown up or more of a man when you finally buy your own house at such a young age. Like it was a sense of achievement, even though I,
yeah,
I wish it kind of, if I was maybe 4 months later, that's when the crash happened.
yeah,
I would not have got approved for the deal, and I'd be sitting here maybe laughing,
yeah.
saying,
For me,
"Missed
it
it."
was like 9 or 10 months later, so we bought around the same time. Yeah, funny. Cool. That was a very interesting talk because usually we talk a lot about purely about investing, but I think for many of us who are on this journey to financial independence, it's a really, really important topic. So
Yeah,
yeah, it was really interesting to hear your side of the of your perspective on this, effectively.
yeah, yeah. Cool. So we might jump into some listeners' questions.
Yeah, let's do that.
Okay, cool. So number one, I don't think we have to say who it is anymore. It's our boy Phil. And he has asked us, which stock would you kick out of your portfolio and which one would find its way in?
Okay, so I'm next week he will ask why haven't you done it yet, but for me it would be ExxonMobil or Bayer. I decided to hold them still a little bit, but those would be the if they put a gun on my head, I think Exxon will be the first one to sell, or Bayer, I don't know, one of the two. Maybe I will do a mix of them. And the one that I would like to find its way in, and I consider this as a question that I don't look at the valuation, but one of the stocks that I would love to own is Nike. I saw the other day a report about teenagers and the top brands they are using, and Nike was in there again. And I think like Nike has such brand power, it's there to stay for the next 20, 30 years. It's a stock for me that's always expensive, but it would definitely find its way in the portfolio.
The stock would want to be expensive. My son got a voucher for his birthday a couple of weeks ago, and he got it for a particular shop, and he wanted these Nike trainers that he has.
Yeah,
140 euro they were. I mean, only for he had a voucher for that shop. I would
yeah.
not be buying from in a million years. But that's what all the kids. That's what all these friends wear. That's what they're all wearing. So I agree with you. Nike is here to stay.
Yeah.
They might consider lowering their prices for me though.
Yeah, and I would definitely, if your son likes Nike and he also likes investing, you should buy him the book Shoe Dog. It's from the founder of Nike. You will
Oh,
like it.
that's cool. Might put that in the description so I'll remember and I'll definitely get that for him.
Yeah.
Okay, for me, I would kick out Verizon. Um, I have a few shares. I can't remember if it was 5 or 6 shares of them. Very, very small. I bought them as, I don't know, I think a hedge to AT&T at the time, but there was no need to have both of them in. And I would like to have Texas Instruments in my portfolio.
Oh,
It's a
also
company
a
that,
nice one.
yeah, a company I really like, and again, ignoring valuations. But I always feel like they're expensive, but I, I feel like I'm going to buy a couple of shares because otherwise they'll slip off my radar just to, like I did with
Yeah,
Microsoft, something similar,
yeah,
just
yeah, exactly.
start building slowly and hopefully they'll come down a little bit so I can average in.
I think over the last 6 years, I've looked every year, one time in Texas Instruments, and all the time thought like, ah, they made such great calculators, but I never pulled the trigger.
Yeah. Yeah. So yeah, they're one. I wrote about them in a blog post the other day, so that they're fresh in my mind. So I'm thinking about just pulling the trigger on Monday, buying maybe 2 shares, and then they're in my portfolio, and I won't forget about them then.
Yeah. Okay. And the next question is from Vladi Vayner. Is this a real name?
I don't know. It's from
Okay.
Twitter anyway.
Okay. He is asking, are you reading the 10Q reports along with the 10K reports? And what's the most important metric you are looking for in that report?
Yeah, I mean we do. Well, I do. I look at the 10Q reports. In Europe, it's mainly trading results. They don't give you in depth. So in European companies, I'm looking at that they're keeping in with the trends. Everything is okay. And the same in the 10Q. I'm not drilling down into the fine details like a 10K, but I do like to see that there's nothing going to rear its head that's going to affect our business. Sales is going, our revenue is expected, and everything is okay.
Yeah, I do the same with the thank you. I scan them. I
Yeah.
don't really read them, so I usually read the. So what I do read is usually the press release part, and then I go straight to the financial statements. That's usually what I do. And then if there's any note that catches my attention, or if there's anything awkward in the numbers, I start digging and looking for it. But you know, at thank you nowadays, they also have like 80 to 100 pages. God knows how many. It's impossible to read this. Yet it costs a day. So
Yeah, the first 20 pages is normally about the business or
Yeah,
stuff like
yeah,
that. So
yeah.
you can discard most of the first half of the report.
Yeah. And the most important metric, I don't really look at metrics when I read a 10K or a 10Q. I just look at the financial statements. I have in my head what I'm kind of expecting for the companies that I own already. So I want to see that the trends are there, that they are managing their working capital well, that free cash flow is well, that they are not financially engineering. These kinds of things I look at. Um, because metrics are a result of that. If I see the debt going up, and I see the left side of the balance sheet staying the same, I know there will be less equity. Yeah, so the debt equity ratio is rather a result of that observation then. So yeah.
Good. Okay, so we're going to move on to our first inflation-based question today, which is from Nick Scott. And he has said that he's heard predictions of a long period of high inflation. I think it's 10 years greater than 7%. How would your strategies change in a period of high inflation? Do you think stock prices would fall and dividends increase?
Um, well, honestly, I don't know what will happen, because Uh, I've never lived in a high inflation environment, at least not as an adult. So it's for me uncharted waters as an individual. So I don't know what I've learned from looking at history and listening to the more older people out there. It's like the best one of the best things is to do is to stay invested, so not have any cash. I'm having a bit too much of cash, naturally, because of my war chest, and I already gave myself this year a bit of a push in the back to spend more every month. But actually I don't expect my strategy to change so much, because my strategy is designed to weather all kinds of stock market environments, and that's why dollar cost averaging is for me that fits me well. So I guess pushing myself harder to have less cash is probably the biggest thing that would change. Other than that, not a lot, I think. But we'll see over, let's say, in 3 years from now, then, right?
Yeah, I mean, looking at the history, I put a graph in our notes just to illustrate. It's been over 7% for most of the 40s, 50s, and maybe most of the 80s as well. So this has happened before. It's obviously in the history, and like you said, most people would say in those times stay invested in stocks, keep as less cash. Maybe gold is a good hedge against inflation and so on. So these are probably strategies that you could employ. I don't know if I will change. I really don't. I don't envisage that I will. Like you, I've never lived it before. I don't know. What I did find interesting is, will stock prices fall and dividends increase? I mean, stock prices, I don't think there might be a little bit of turbulence in the next, I don't know, couple of months because of inflation. But once it becomes the new norm, it'll stabilize, and stock prices will do what they do anyway. They will follow earnings and they will follow revenue.
Well, if inflation is really going to be 7% for the next 10 years, we will go to a high interest rate environment. And that will really, I said, that means that money becomes more expensive. That means that our companies that we had that were so massively buying back shares will have less cash flow because their interest rates will increase. Hence, they need to stop buying back shares and need to start lowering their debt. So this also probably means that valuations of companies will go down because it becomes less attractive for an investor, because there's less money left for the shareholder because it has to go to the banks. So from that point of view, yes, I do expect when interest rates increase, that the multiples go lower. And it's even when I do a discounted cash flow calculation, I use, for instance, the weighted average cost of capital. It might be now 6.5% for many companies, but if it goes to 9%, that might be, I don't know, that 2% or 2.5% might be 10, 20% differences in valuation. So yes, I do expect shares to come down, but my strategy doesn't change. I actually would be more happy because I get to buy those companies at a lower multiple compared to their dividends and earnings. So yeah, from that point of view, I would be actually happy with it.
And I wonder, would it expose companies that like to use financial engineering tactics, particularly with buying shares like IBM. They won't have the opportunities that they have now to buy at such a low interest, and it will certainly affect companies like that.
Yeah, yes, of course, because they will need to refinance debt at less interesting, less attractive interest rates.
Right.
So it's not like inflation as a direct result in higher interest rates, but you see why they're looking at the Fed, right? Because the Fed has a goal to keep the inflation at what is it? On an average of 2%. So if the
Yeah.
average becomes 7%, then they will need to increase the cost of money to make it less attractive to grow prices so fast. And that's why inflation then would be expected to go down. And yeah, for that, share prices will be, I'm not saying that necessarily they will go lower. We might see a kind of a crash because the market is not used to it, specifically when it's sudden. But at least I think we might be in a decade like we had from 2000 to 2010, that it was effectively dead money if you put it in an index fund and not did anything. Yeah, but I would be happy because it would be more a dividend investing decade. Yeah.
Yeah, we'll be back to the moon, baby. I can't wait to say that on Twitter and actually mean
Wow.
it.
Yeah, exactly. And our social media followers will quadruple in a few months.
Okay, the NL dividend investor has asked us, what are the theories, principles of your daily life that you use in investing? And the same thing, what are your principles in investing that you use in your daily life?
So in my daily life, I don't buy stuff that I can't really understand or that I don't understand. The same is what I have also in investing. I need to understand it. That's why I spend sometimes too much time on analyzing companies. But then again, what I learned from investing is to don't look at price, but at value, because often you see like, this is trading at 20% discount. And now I learned to check, is that even really so? And then you see in Amazon or something like that, that the price was always the same. They just increased the price. And it was not Amazon, it was other web shop actually. They just increased the price 3 weeks earlier to then give you a so-called discount. So it's more about the value that I started looking into, like 3 for 2 or 2 for 1 I used to buy in the past and then throw the other half away because it was rotting afterwards. So I became much more conscious of what I'm buying, and then actually I care less about the price nowadays than I did in the past.
Cool. Yeah, I think one of the things that I've brought over from both sides is I never buy what I can't afford, and that includes car. No, like people take out loans for cars, or I just don't take out loans if I can't afford it. I won't buy it, and it's the same in investing. I only invest what I can afford and what I can afford to lose, and they are kind of interchangeable. So
Yeah.
that's what I've really brought over. I don't really know what else investing that I use in my daily life. I've become a little bit more aware, like you said. I need to understand why I want the company and how long I'm prepared to invest in them for. But I think for me the big thing is I only buy what I can afford in both areas
Mm,
of it.
yeah, makes sense. Then Jose Carlos is asking, when analyzing a company, do you consider any key investing stopper, or do you pay special attention to any metrics under this inflationary environment?
I mean, depth is going to be crucial, especially as interest rates go up. So companies like AT&T, you would be a little bit, I would say, crazy to start investing in them when inflation rates are going up and they're going to borrow at high rates.
Yeah, for me, in this inflationary environment, I mean, eh, let's say like that. If I have a fear that a crisis would come, and this is what usually goes through my mind, straight away I start looking at my portfolio and thinking like, do I have some bad actors in here that have a really bad balance sheet? Because companies with good balance sheets survive almost any weather unless their revenue start falling literally off a cliff when you're in the blast zone in a crisis. If you're not in the blast zone, then a good balance sheet is almost always going to survive. So it's really a question about the balance sheets, and I think this should be, and that's what I started doing. This should be a routine, not a one-off when something changes in the market. I should generally know how good the company's balance sheets are. And I know there are a few in my portfolio where I need to keep paying attention to because of the buybacks and these kinds of things.
Yeah. Actually, I have to give a shout out to Jose because he found something I need to correct in my Vinovia article. I transferred some numbers over that I copied incorrectly. So he took the time to read my article, do his own due diligence, and come back and actually explain it to me. So I appreciate the time that took and to do that. And I will rectify that
Nice.
probably this weekend. So thanks a million.
Cool.
Okay,
Yeah, and
so the last question is from Enzo. And he asks us, do any of us use the price to book ratio or if we use any multiples in the industry?
I don't use the price to book ratio. I know it is famous for, I believe was it Ben Graham and Buffett in the past, also for evaluating banks and such. Well, I don't have bank stocks, so that makes it easy. If there's any multiple that I really like to look at, it's the price to cash flow multiple, free cash flow multiple,
Mhm.
but only when the company is showing stable cash flows. Only then. Also, the price to earnings I like to look at from time to time, but again, that only works for a company like for me, like Johnson and Johnson, such only with stable earnings. Other than that, I really don't look at the multiples that much. I go straight into the balance sheet and into the other financial statements.
Cool. Okay, so that's all the questions then for this week. Thanks a million to our listeners again. Some really good questions, and some of them I'd actually wish I had some more time to prepare because they're really make you think. But no, thanks a million. So we look at the stock pick this week, and I believe it's my turn. And this one is going to be inspired by Decliner Capitalist, who roasted our portfolios live on dividend day when he mentioned our maybe we had too many high yielders, and we both said we prefer high growth. So inspired by Decliner Capitalist, I'm going to pick a low yield, high growth company this week to look at, and they are Zotis. So it's ticker ZTS. They were a spin-off from Pfizer Pharmaceuticals. They mainly are in the animal health pharma sector, which is quite interesting. There's some tailwinds in that industry at the moment. Lots of people, particularly since COVID, and people need companions, maybe with pets and so on, and they're starting to spend a lot more money on their pets. Even vaccines in this segment is going up a lot as well as people are transferring over to their pets. So they've been created, was it 2013? So we've got 8 years of dividend growth every year since they've formed. The dividend growth is 21%. As I said, they have a 0.6% yield, so it's a very low yield, but really high growth. Earnings has grown 17% per year in that time as well. And as I said, there's really strong tailwinds. So I believe the company is overvalued. They've had a huge run up at the start of this year. I wish I could have looked at them before that, because they would have been very interesting to me around maybe the 90 euro mark. I think they're at 172 euro now, or dollars. But it's definitely a company I would be interested in if it dropped. It's an interesting space.
Yeah, so I never heard of it. And before the show, we spoke a little bit already about it. I said, is this Pfizer? Is it like Philips? Like all the spin offs are making people wealthy, but not the company itself?
Yeah, I mean, looking at the returns that this company have had over the last 8 years, they've nearly always been above 20% per year. I expect that to be lower this year because of the share prices
Mhm.
gone up so high, as long with everything else. But I'm still expecting high returns from this company in the next couple of years. It's definitely definitely an interesting one.
Nice one. So I'll have a look at it tonight or tomorrow. I mean, you made me curious. Oh, thanks, one. Thanks for this one.
Okay, hey, we can thank the client capitalist. He asked the question, why don't we look at low yielders? So it inspired me to look at this.
Super. Hey, this is the end of the show already, EMF. It went really quick. Officially, we started season 2 today. Yeah, so we did 52 episodes. So this season 2. So let's put it also on our how is it podcast platform as season 2.
Season
And
two.
But episode 53, I mean, we need to go to 100 and then thousands. So
Episode
we
a
need to
thousand. Can't wait for that.
we need to build a legacy like Charlie and what is it, Warren, something
Yeah.
like that.
I mean, I've said it before. I love doing this, and even though you can still hear my voice. It's it's a struggle for me to talk at the moment. I couldn't miss. I don't like missing this at all. So I make every effort. So it's been a pleasure, and as always, pleasure talking to you. It's you come out with all these little nuggets. So you keep inspiring me.
Oh, likewise, EMF. I mean, we learn so much from each other. It's kind of the flywheel.
Yeah, yeah.
So good.
So
So everyone, have a great week. We hope you enjoyed the podcast. We don't bite, as you know. We always are more than happy to answer your questions. So if you have some, you don't need to wait until next Friday. Just send them in via email, dividendtalk@gmail.com, or ping us on the social media. You have a pretty good chance that we'll address them. So everyone, have a great week.
see you next week.